Well, thank you for having me. Happy to be here. And just to give a little background to those that might not know as much about Cheniere, um, we're the LNG company. The ticker's LNG. We're the one exporting the gas out of the country. But when I started working with Cheniere, I was actually at CS in New York, and it was an import story. It was the idea that there wasn't going to be enough gas in this country, so we were going to have to import it from Trinidad or even Russia at the time. So we were building an import terminal, and right when it got online, the shale revolution occurred, and things were looking pretty dire for this company. And when things are sometimes dire, you come up with your best idea, and the idea was to turn it around and become an export story with the excess gas in this country. Basically, when I joined the company, or even when I was a banker for it, the stock was around $1. It had a precipitous fall with the shale revolution. Stocks 10 years later, it's hovering for the last year or so in the 160s. So it's been a heck of a ride. Cheniere is now Fortune 122, global Fortune 450. It's a $40 billion market cap, $70 billion enterprise, third largest company not in the S&P 500 at this time. So that should come. And operationally, we consume around 10% of all the natural gas in the United States. So every day, our two plants, one in Louisiana at Sabine Pass and one in Texas at Corpus, take in around 7 to 8 BCF a day of gas, and the country as a whole produces about 100 Bs a day. That amounts to around over 50% of all of the LNG exports out of the United States, and over 10% of all the LNG exports worldwide. So we're the second largest operator now. And it's been a heck of a story. And getting into some of your questions, really what has been at the foundation of this thing has been the long-term contracts. We have these contracts that are basically, whether you need the product or not, for 20 years, you'll pay us a fixed fee, and that fixed fee alone can cover our operating costs, our debt service, and earn a return. If you want to lift the LNG, you pay Henry Hub on top of the fixed fee. That's a pass-through to allow us to go acquire it in the market. And that's the story. We basically went on this historic infrastructure build and spent around $40 billion. And our name wasn't Exxon or Chevron. How we did it was we raised around $32 billion of debt, or about 80% of the whole build out was with debt. And you can imagine we were probably one of the biggest high yield issuers for about a decade, quite popular in these neck of the woods for a while. And basically we were only able to do that because these contracts with customers all over the world were pretty rock solid, that we were going to be able to earn a return regardless of the commodity environment. And for example, in 2020, LNG prices around the world were around $3. Gas prices in this country were even $2 to $3 as well. There was no profit to be made. And with the fixed fees that we get for about 90 to 95% of our capacity, we were able to meet guidance that year, make it through, refinance our debt, and be in a solid position going forward. Fast forward 2 years later, and thanks to we've been able to get more capacity out of our liquefaction trains. We were able to bring them on early with our partners at Bechtel, who built all of our infrastructure. We had excess capacity to sell in 2022. And with that, we were able to make around $11.5 billion EBITDA, or about $6 billion of incremental profit. Allowed us to get to investment grade as a company, pay down around $7 billion of debt over the last 2 years. And now we are looking into the future. And it still comes back to those same long-term contracts that you were speaking to before. However, instead of using those long-term contracts to raise debt, we're using that to fund our equity. And with the visibility you have with these long-term contracts, yeah, it gives us a ton of flexibility to do so. So it's been a wild ride. I'm a New Yorker through and through. I told my wife we'd move to Texas and this thing probably wouldn't work out in 2 years or so. And now we have 3 Texan girls. So we're probably there for the long haul. Sure. So we try to communicate. I mean, this is just not your typical public company. We're quite a large public company at this point, and it was a unique way to raise so much money in so many different ways. I mean, 2 of our biggest investors are these 2 infrastructure funds in Blackstone and Brookfield, were their biggest investment. So we've had a unique story in the capital markets for quite some time. And being this ticker LNG, now more and more people know about this company by the day, especially after what happened in 2022 when Europe had no access to Russian gas anymore. And we actually had budget meetings last week, and Randy, my head of IR's budget went up because now we have to send out double the amount of annual reports, because that's how many more investors are now involved in the story. So that is a good thing, but at the same time, we get a lot of questions on earnings calls, at conferences like the one I'll do tomorrow. Basically, what do you think about the prices for next month? What do you think is going to happen early next year on LNG prices? And basically, this company doesn't exist if we were a merchant open capacity company that was just beholden to that price on the Bloomberg screen. That's how we were able to raise so much debt and ensure that that debt could be repaid over time. And that's why, yeah, companies in the oil and gas space that are mainly uncontracted get valued at 4 to 5 times, maybe 6 if they're the premier operator. And a bad multiple for us is 10 times because our cash flows go out for 20 years and are pretty rock solid with inflation protection, regardless of the commodity environment. So we try not, you can't be in this business spending tens upon tens of billions of dollars and just hoping for the best with the commodity. And that's where those contracts come into play. So I on the last earnings call, I said, look, I obviously know what the LNG price is day to day, what TTF, the European gas prices, or JKM, the Japanese gas prices, and Henry Hub. But then I look at EBITDA every day and it doesn't change. And our guidance is rock solid because it comes back to those contracts. So I think sometimes people like to make this into something more sexy than it is. It's just like 2 massive project financings that we've done of a product that's pretty much in the money in all parts of the world.
Well, as listed infrastructure investors, we appreciate the value of boring. So, yeah.
Well,
keep it going.
I'd root for some of the other LNG operators to be as public as we are with quarterly earnings calls and hold themselves as accountable because it's a lot tougher. Yeah, you said I've been at Cheniere for 3 years as CFO. We don't call it years; it's 13 earnings calls. That's how you calculate your time as CFO. Sure. So I don't think this was ever part of the base case that there would be such an event where eventually, as it turned out, that if Cheniere, this company of 1,500 people in Houston, Texas, with just 2 plants, one in Louisiana and one in Texas, where its own country, it provided more LNG to Europe than any other country in the world last year. It all went there. And when Randy and I go all over Europe now, because we have a lot more interest in other parts of the world in the story, they're not just interested in investing in this company, but grateful for what we were able to accomplish for the continent. So that was huge. At the same time, there's still tons of headwinds in the policies. And basically in the last year or so, there's been a lot of long-term contracting, but most of the long-term contracting for LNG has been super majors and portfolio players. That alone has been 50% of all the long-term contracts. So basically they can see out that if you have a net zero target of 2030, 2035, 2040, 2045, what have you, there's going to be a need for baseload energy that is clearly the cleanest available and reliable, and it's going to be LNG or gas. And they will sign up the long-term deals with their credit ratings with folks like us, and then they will sell on a shorter term or in the spot market at these elevated prices to European utilities that don't have the government support to sign up these long-term deals, even though it would have been an absolute no-brainer. Just to put in perspective, the prices that we were selling, the minimum open capacity we had, the 5% or so, was around $40 per MMBTU of margin. So one cargo a day could make an extra $150 million of profit, and we shipped 2 a day. We only made $6 billion of incremental profit because we were 95% contracted. But if you had a contract with us, you would be paying $2.50. So you'd be paying a tenth, or even less. So basically that is an issue that was driving the market for some time, but there was thawing in long-term contracting because a lot of these folks could see out further and that there was a huge opportunity, a clear opportunity for LNG. The other big dynamic is China. China is 20% of all the long-term contracting that's been done. We just signed a few deals. One goes out to 2050. They're basically a portfolio player as well. Most of their LNG over the past year has gone to Europe at the elevated prices. And what do? They turn back on the coal and are just optimizing price and knowing that they have enough energy security for themselves. So that has been an issue in terms of winning over direct European companies that we used to be able to win them over left and right as we got this thing started a decade ago. But we see some thawing. And some of that has been with some big players. Our last contract that we signed goes to 2045 with BASF, who's delivering this LNG into Germany. Germany didn't even have a regas terminal to take in LNG a year ago. And they definitely didn't have a net zero target that goes into the 2040s. Now they're in a position to sign a deal with us going out to 2045. We've also done a deal with ENGIE recently in the last year, as well as Equinor, the Norwegians. All three of those companies are government owned. So there is progress occurring. It's just that it's a little slower and it's probably not as large as it should be. But as we look out further in terms of this market, the LNG market is still pretty small. The LNG market is 400 million tons, which is only around like 3% of global energy. Gas as a whole is about 25%, but it's only 3%. And the market is set to go to 700 million tons, not even double by 2040. That's as big as it can be because these projects are really expensive to build and they take a lot of time. Back a few years back, we thought there would be 3 supply hubs for new LNG: the US with our excess gas and ability to get it to the coasts, Russia and Qatar. Now there's only 2. And in terms of the demand for this LNG, because that had to be met, for the most part, it was all coming from Asia. It was about 75% Asia. China was a quarter of it, then there was Southeast Asia and then South Asia. That makes up about 3/4, and the rest was scattered around the world. Now with the dynamics in Europe, they're almost going to double their import capacity. They're going from like a little less than 150 million tons of import terminals to 250 million tons in the next few years, really before the end of the decade. So now there's an extra demand node and one less supply node. So it's a pretty interesting setup for a company that can provide this LNG.